do. Okay, normally what I would do is if there are a bunch of people that didn't show up to reward the people that did show up, I would give an extra credit question. But then since it's recorded, people could do that and get it anyway. So, but it looks like we got enough people here. Okay. So I'm not going to take roll. I was going to take roll, but I guess we got quite a few. Okay. Any questions on what we've been doing, last time when we were talking about capital gains, or excuse me, the corporate income tax? And again, you might want to just take a look at some of the articles that are in the corporate income tax subfolder in your folder there. So today we're going to start talking about a consumption tax. And we've already sort of talked about it a little bit. So when we were talking about, for example, when we talked about a tax on gasoline, right, or an excise tax, a tax on a particular good or service. Now, the primary example that you see for a consumption tax is, of course, the sales tax. And we'll talk a bit about, in a moment, about the sales tax. But the sales tax is, something that you see pretty much every day. When you go out, you go to Walmart or something and you buy, buy products, you'll have a sales tax that you pay. And we'll talk in a moment about how that's actually implemented. But for example, just if you were to say, well, let's do a consumption tax. What was an advantage of a consumption tax is that you only pay on consumption, and so what's going to happen? So that will, in a sense, encourage savings. Right? So if you had a comprehensive income tax, remember that you're going to tax on changes in your net worth, right? That was if we think back to the Higgs-Simons comprehensive income tax. But you're only going to pay taxes on your consumption. So if you looked at an income tax, you made $300,000, but you only consumed $100,000. Then you don't have to pay taxes on that part that you saved, and so you'll get an increase in savings. Of course, that will, if you have more savings, you'll have more investment. More investment means you have more capital stock. You'll have greater output, higher margin product of labor. We can sort of work through the unintended consequences of these things. Or it might be intended consequences, right? If you've had Econ 402, you'd say that might be an intended consequence. We observed that. So another question then is this a reasonable ability to pay measure? So is it a reasonable ability to pay? That is, we might think of ability to pay. Remember, we were talking about horizontal equity and the like. We were talking about income. We were talking about whether tax is progressive or not. You put the amount of tax relative to your income. But maybe the ability to pay is reflected more in your consumption than it is in your income. So again, let's think back a little bit to Higgs-Simons. We had that Higgs-Simons, the comprehensive income tax, right? Think back to Higgs-Simons. What was Higgs-Simons was you have consumption plus changes in your net worth, right? But that's savings, right? So that if you were to take a look at it, if you taxed consumption, if you tax consumption, what was that? That's income minus savings. So the differential then is whether you're going to have a tax on just your consumption, or do we want to have a tax on your comprehensive income? Now, again, we talked about all sorts of problems in trying to measure, right, on the comprehensive income tax. How do you deal with unrealized capital gains, et cetera, in terms of your net worth? But nonetheless, that's the relationship here, is that basically the consumption tax is going to be your income minus your savings, or we could look at your income minus your savings, or we could just add up all your consumption. If we were to actually implement it as a tax like we do the income tax. We don't do it that way, right? You don't get a statement from the state of Michigan, or you don't get a statement from the IRS having you list all your consumption this year, right? But if you were to actually do it as a Hague-Simons measure, that's what you would do, right? You'd measure your consumption plus your change in your net worth. That would be equal to your income. Now, the main concept, yeah.
How does purchasing durable products that retain their worth play into this? So if you purchase a house or capital that is going to, you could sell eventually in the future.
Yes, we'll come to that. That's exactly correct. That is, when we start talking about problems in implementation, again, remember when we talked about you get to under income, we would how do you deal with imputed rent, right, of your house, and we talked about you get under an income tax, you get to subtract the cost of acquiring the income. So the question was, we talked about how much of your tuition is consumption of coming to Hillsdale because it's a cool, fun place to be, and how much of it is adding to your human capital, right? So you're going to have the same sort of implementation issues if you were to do a consumption tax. Now, the primary consumption tax in the United States is a retail sales tax. If you just observe, so it's not a comprehensive consumption tax. It's a tax on retail sales, and that is primarily at the state and local level, but mainly at the state level. And some local units have local sales tax. But it's primarily the state tax. The federal level, you do have, remember that we said a tax on the sale of a particular good is an excise tax. So if you look at the federal government excise tax was $87 billion in fiscal year 2021. Again, if you go to the Congressional Budget Office and you look at their data, it was, again, $87 billion in FY 2021, and the total was $3.863 trillion. The latest FY 2021, so $87 billion out of $3.86 trillion. So you can see at the federal level that although they do collect $87 billion, it's not a lot. All right, there are 45 states that collect a sales tax. Right. So if we look at the total was for the latest numbers. There's an annual survey. So there's an annual survey of state government tax collections that you can get from the U.S. Census Bureau, and the latest number that they had is for 2019, and it was the total for the states is $335 billion. right? So this is the 45 states. Remember that I said last time there were two states that did a gross receipts tax? So this includes the gross receipt tax when you look at this $335 billion number. There's $412 billion for this is the sales and gross receipts, but it's primarily the sales tax revenue. If you look at the income tax is $412 billion, and these are the two largest sources of revenue, of tax revenue for state governments. So you can see that the sales tax is a large portion of the tax revenue. In fact, it's 31% of state. If you take the 50 states, it's 31% of state tax revenue. So about a third of the state tax revenue is coming in from the state sales tax. Now, in 1955, again, just like you should be familiar with Haig-Simons in terms of if you take public finance, it's sort of a famous articles. There was a famous piece by Nicholas Caldor that he wrote in 1955. And Nicholas Caldor it was a book, and it's called An Expenditure Tax. So I'm sure you're not going to go out and read it, but it's going to be like I've said, there's a lot of famous books out there that everyone's heard of and no one's read. This is one of those books, right? I mean, you should, oh yeah, Nicholas Caldor, Expenditure Tax, yeah, I know what that's about. But what that was really about is he said that expenditure is a better measure of ability to pay than his income. And in the public finance profession, that is a little bit of a debate. Is ability to pay as good a measure as, or what is the measure of ability to pay? When we're talking about efficiency and equity, right? And we're talking about vertical equity. When we were talking about vertical equity, we were talking pretty much about income as the vertical equity measure. But Caldor was arguing that consumption is a better measure, or your expenditures are a better measure of ability to pay. And what he was focusing on is that, look at individual utility. Right? When you look at your utility function, right, what are you looking at? You're looking at what are you using up, right? What are you consuming? So his argument is that you increase your utility through expenditures, but you don't increase your utility by saving. You're just delaying you're just delaying your consumption into the future. Again, we've made the point of, how many have seen Scrooge McDuck? Can't believe this. Okay, you gotta watch some cartoons. Look up Scrooge McDuck, okay? Anyway, it's a cartoon character, but he just wants to save. He just wants to have lots of wealth, right? Doesn't necessarily care about spending on anything. But for most of us, individual utility is a function of what we buy or what we consume, right? So what he's arguing, what Caldor argues, is that saving only increases your ability to consume in the future, right? So savings just increases your utility in the future, right? Because I can consume more in the future. So his argument is that that ability to and from an equity standpoint, it's a better measure of ability is a better measure of in an equity standpoint. Okay, so there's in your well, I'll talk about that in just a second. But then he also argues or emphasizes that increase in the capital stock comes from savings. Okay, and we've noted that several times when we were talking about the corporate income tax and talking about the corporate income tax in the non-corporate sector and how investment changes, et cetera. So what he argues is that if you save, what happens? If you save, you increase the stock of capital. So if you increase the stock of capital, then what happens is that you're going to have a future production and allow for future consumption, right? So it provides future consumption. And that's good for everybody. Because what's going to happen, if I increase the stock of capital, I'm going to increase the marginal product of labor, I'm going to increase the ability to produce, and so we're going to have the benefits all from the increased output, right, that we're going to have in the future. And so that he emphasizes that that by having an expenditure tax, you're going to, first of all, that what your utility depends on what you are actually consuming, okay? And unless you're getting utility out of just savings, maybe, like I said, Scrooge McDuck, he gets utility out of having lots of wealth, okay? Even if he doesn't spend any of it. But when you take Econ 202, what do you stick in the, when you're doing utility functions, right? You don't stick in savings. You stick in, here's how much X I got, and here's how much Y I got, and here's how much Z I got, right? And so Caldor is focusing on that piece, and then also emphasizing that there's a benefit to society as a whole, in some sense, from your savings. And so what we ought to do is we ought to tax expenditures rather than taxing income. Now, there's an article that I put in the subfolder under the consumption tax portion of the subfolder. It's called "Are Income and Consumption Taxes Ever Really Equivalent?" Okay. So just take a look in the subfolder. It's a lengthy paper. It's not something that you need to read in order to to get your A on the exam. But again, if you're thinking about what you're going to do in terms of your paper, then it might be something you want to take a look at, or at least look at the summary of the thing. Anyway, it's called "Are Income and Consumption Taxes ever really equivalent?" And it's sort of an interesting paper in that what it looks at, how many have had behavioral economics? Anybody take Clark's behavioral economics? Okay, it's a behavioral economics sort of paper. And what it's talking about is that what happens with a tax on an expenditure tax, or it's an income tax and a consumption tax, the effect on the labor-leisure trade-off. All right, so it looks at the behavioral effects on the labor-leisure trade-off, and what that's the amount of work the labor supply, let me just put it that way, on the labor supply. They look at the effect of labor supply if we were to shift to a consumption tax, right? If we moved from an income tax to a consumption tax. If we move from income to consumption. And remember that when we were looking at the comprehensive tax on wage income, what happened when we looked at the income and substitution effects, right? And we noted that if you were to the substitution effect of a tax on wage income makes leisure less expensive, and so you'll choose more leisure, right? You did all that on the midterm. They looked at some behavioral economics studies to see if people really do that, right? If we were to switch from an income tax to a consumption tax, would it affect people's behavior? You would expect that the income tax has that excess burden from affecting the labor-leisure trade-off. Anyway, so it's sort of an interesting paper to just take a look at the effect. Now, if you look at recent years, what's been going on in terms of the income tax? If I were to, again, if we think back to Haig-Simons, if what I do is I let you subtract off your savings, if I let you subtract off changes in your net worth, then it becomes a consumption tax, right? So so over time, what we've been doing is we've sort of been doing that. If you've ever, when we talked about the income tax, we talked about the what happens if you get to deduct savings. And we noted that there's been a tendency to do that, right? And what did we talk about? We talked about, right, individual retirement accounts, right? We noted that when you're looking at the income tax in the United States, we made it so that you could, if you're have an individual retirement account, what happens? You get to deduct the money that you put into the IRA, depending on what your income is, but you deduct the money that's going into the IRA, and then it's taxable as income when it comes out, right? Now, the Roth IRA, for the Roth IRA, you put it in post-tax, but it comes out not taxable, right? So we had the IRAs, we had Roth IRAs. We have your, basically your, what's called the 401k, which is where, like the Hillsdale College, I can put money into this, the 401k, which is a savings account or retirement account, and that's not taxable to me when the portion up to a certain amount. Again, it's fairly complicated, but the point is, up to a certain amount, money that I put into the 401k, and actually, technically, this is the 401k is the basically retirement savings account that you have if you are a for-profit. And we noted that a 403b is for nonprofits. So technically, Hillsdale College, when they put money from my earnings and they put it into my 403b account, it's called a 403b account because it's a nonprofit. If this were, General Motors, it would be called a 401k. But the bottom line here is that we've been allowing for deductions. We have health savings accounts. So what's been happening is over time there's been a movement in the last 20 years or so towards allowing you to deduct a certain amount of savings, right? So from an income tax, that would be moving us more towards a consumption tax. All right. Now, let's just have some comments on if we have a tax on consumption. Sort of, again, whenever you go to implement one of these taxes, just some comments that we might make. And the first one is, suppose that I took a flat rate consumption tax and an equal flat rate income tax. So I'm going to take the same amount of money out, right? I'm going to generate the same amount of taxes. So suppose what I do is I substitute a flat rate consumption tax for a flat rate income tax with the same yield. So suppose what we did was we just eliminated the income tax, and what we did was we said, okay, we're going to tax your consumption, which is your income minus your changes in your net worth, okay? And we noted that you could look at it from the use side or the source side when we were talking about the comprehensive income tax, the Haig-Simons version. But suppose what we did was we just taxed consumption, and we did not tax the change in your net worth. Well, first of all, you're going to need a higher tax rate, right? Because you have a smaller base. So what's that going to do is, again, you're going to have to have a higher tax rate on sales tax if we were to a comprehensive consumption tax. Taxed all sales, whether they were goods or services. And so if we were to have a comprehensive consumption tax, then we'd have to have a higher tax rate. And now, remember that if we'd have no excess burden from the taxation of interest. Remember when we looked at the taxation of interest income, what did we have? Remember we put the consumption in the present and consumption in the future, right? And we looked at the substitution effect of that, and then we looked at that there was an excess burden from taxing interest income, because you're altering what people would be doing normally in terms of how much they were going to consume in the present versus consume in the future. Okay, so you're going to eliminate the excess burden that you'd have under the personal income tax by not taxing the tax on interest earnings. Now, capital income is excluded, and so the tax is going to be borne basically by labor earnings, right? So it's sort of a third thing is going to be the tax is going to be borne by labor earnings, right? Because you're not going to tax earnings from capital. You're not going to be taxing interest or increases in in the capital stock. Now, that tends to distort the labor-leisure choice, though, right? So you don't have this excess burden from the taxation of interest, but it'll tend to distort the labor-leisure choice, right? Or the labor supply. How much work or we'll call that the labor supply. And what that means, why is that happening? Because you're going to have to pay a price which would include the tax when you go to buy stuff. So if you work an extra hour, right, you now don't get as much consumption as you did before. So in a sense, it's a reduction in your wage from if you have a tax on consumption. So it will cause a excess burden in the sense that it's going to distort the choice of labor and leisure. Every hour that you work, you can't buy as much stuff as you could before, right? Because you're paying a tax on the consumption. But if you add to the capital stock, what's that going to do? That's going to increase the marginal product of labor, right? So wages ought to increase, right? So anything that I do to add to the capital stock, what's going to happen? We know from ECON 202, the value of the marginal product of labor depends on how much stock of capital there is. And so I would be increasing the stock of capital, means I ought to be increasing increasing wages in the future. So just some observations when you're again seeing, observing, when you take a look at, okay, if I were to switch from a comprehensive income tax and move to a comprehensive consumption tax that generated the same amount of revenue, like I said, you're going to have a higher tax rate because your base is going to be smaller. You're going to have eliminate the excess burden that you had on interest earnings, but you're going to make it so that your wage can't buy as much stuff as it did before, which in a sense is a tax that's borne by wages, and that's going to affect the labor-leisure trade-off. And so again, that's going to be compensated by the increase in the stock of capital, increasing people's wages because the value of their marginal product has gone up. Yeah.
Does it also though affect the owners of capital because they are getting money from the rents, right? And they still are going out and using that for consumption, which is then taxed. So
yeah. So you're saying that it's not that because that if I'm getting a return on my investment savings, then I'm going to have more consumption in the future, and so in a sense, the tax is going that way. Yeah, I guess you could sort of think of it that way, but primarily the point is that yeah, I'd have to think about that. That's a good question. I'd have to think about that a little bit. I'll come back to you on that one, right? But the point here is that I'm not taxed, but I'm not directly taxed on my savings. Okay, so by not being directly taxed on savings, I don't have that problem that we had when we taxed interest, where we altered the choice between present consumption and future consumption and ended up with a substitution effect there. Okay? All right. Let's talk about a little bit of some of the problems when we go to implement this thing. Just as implementing any tax, problems in implementation. And these are, as I said before, these are similar to when we were looking at the problems when we were looking at an income tax. One is again, you can think of these yourselves. These are just some points that seem a little bit obvious. One is, how do I tax home purchases? Right? If I tax, when you buy a house, are we going to tax the whole amount of the house? And how much of that is savings? If you look at data, you'll see that for a large percentage of people, the majority of their wealth is in the equity in their house. A lot of people have more equity in their house than they have in their brokerage account. Okay, so when I buy a house, some of that is savings, right? So I'm getting equity in the house. Now, if what happens is you buy a house in Hillsdale for $150,000, and then 5 years later the house is worth $500,000. Okay, what's happened? That was savings in a sense, right? So equity in your house is a significant portion of the wealth of a number of people in the United States, and so how do I measure that? How much of that home purchase is consumption? And again, that was the idea of imputed rent. Remember when we were talking on the income tax side? I got to figure out, okay, what is the imputed rent? So it's a similar type of story. And then again, when we were talking about education, we got the same sort of thing here. Is that how much of education is consumption? And how much is it savings in the sense that it's adding to your stock of human capital? Okay. So again, how much of education is savings is another problem. We already talked about that when we looked at the cost of acquiring income. Something that is important on the consumption side is taxation of intermediate goods. Think back to ECON 203, right? And you're measuring gross domestic product. You don't want to count the sale of the steel, and then the steel gets turned into a car, and then count the value of the car, right? What are you looking at? You're looking at, when you add up GDP, you're looking at final sales, right? You're not looking at sales of intermediate goods. We got a similar situation here. That is, what happens if I tax the, when Amazon buys a car, let's say buys a van. When Amazon buys a van and then it uses that van to drive around and sell product, right? Some of the cost of that van is going to be showing up in the price of the Amazon goods, okay? And so I don't want to tax intermediate goods, right? So yeah, how would you make that decision, right? Am I going to say, so again, if you're going to try to implement it, you have to deal with this double taxation of intermediate goods if you aren't careful in how do you make that decision? And again, just something that'd be difficult to comply and difficult to have. All right. So again, there's just some observations and general comments on if you were to actually try to implement a comprehensive consumption tax. And of course, we don't, well, come to that in a moment, but we don't have a comprehensive sales tax in the United States. On Friday, we'll talk about the value-added tax, which turns out to also be a consumption tax, but you collect it in a different fashion. But in the United States, we don't have a value-added tax, and we don't have a we said, you know, the excise tax is a very small number, less than $100 billion. So the sales tax in the United States is generally in states. Because it differs by state, it will depend, you know, on the state law what's actually being taxed. But generally, it's a tax on retail sales. The actual sales tax that you see, the actual consumption tax. Let me use a different thing here. The actual consumption tax in the U.S. is generally a state sales tax. And generally, it's a tax on retail sales. In Michigan, that's what the tax is. In Michigan, the sales tax is a tax on the right to make retail sales. The sales tax is not on you. When you go to Walmart and you go to, you know, or you go to, I don't know, go to Ken Stillwell Ford or something, when you buy something from a retailer, what do? You walk into Walmart and it'll say that you know, a box of cereal is $2.50, right? Then when you get to the checkout counter, you have the $2.50, and then what happens? Pops up 6% sales tax. When you get your receipt back, it'll say the $2.50, and then it'll have the sales tax there. That sales tax is actually borne, the actual person that has to pay the sales tax is Walmart, not you. It looks like all that goes on in the Michigan sales tax is that it allows Walmart to post the price as $2.50, but you're not liable for the sales tax. Walmart's liable for the sales tax. So in Michigan is a tax, if you read the Michigan Sales Tax Act, it's a tax on the right to make retail sales. And all that is allowed is that they can post the price without the tax and make you think that, have you ever seen an ad that says, we'll pay your sales tax, right? Come in today and we'll pay your sales tax. Yeah, well, it's not your sales tax, okay? But, you know, again, people are rationally ignorant, so they don't really know that. But the bottom line is it's really a tax on the right to make retail sales. Now, in Michigan and in a number of other states, but in Michigan, the Constitution limits it to a sales tax on tangible personal property. So in Michigan, it's only on tangible personal property. Okay? And again, that's in the Michigan Constitution. Now, as I said, it'll vary among the 50 states. We said there are 45 states that levy a sales tax. But if we look at those states that levy the sales tax, they'll vary. But a large number of them, it's only a tax on tangible personal property. What does that mean? Not on services, right? Okay, so you go to get your you go to get new tires at Glory to God, okay, and you go down there and they have a set of tires. You buy a set of tires and they put them on for you, right? Well, you'll pay when you get your statement, you'll see you have the sales tax on the tires, but then when they put the service charges, there's no sales tax on the service charges, okay? So that is common among state sales taxes, that they are not taxed, they don't tax services. There are some, again, it'll depend on the state, but generally the tax is generally on just not on services, but just on tangible personal property. Now, there's again, there's a concern about what is equitable, and have you read Nicholas Caldor's book? And you see that the true measure of ability to pay is probably based on your consumption, or is it as we did when we were looking at horizontal and vertical equity and talking about progressive taxes. When we looked at progressive taxes, we looked at your taxes divided by your income. So the idea is that, in a sense, we were implying that income was the measure of ability to pay. But if we think about that, some people would say, you know what? I think the consumption tax is regressive because poor people will consume more out of their income in thinking about it in any particular year, but they don't say it that way, right? But the idea is that, when Jeff Bezos dies, he won't have spent all his money. So the idea is oftentimes that they'll exclude food, right? So they don't, not services. And in Michigan, there's an exclusion. You exclude food that is not prepared for immediate consumption. Not prepared for immediate consumption. What does that mean? You go to the Kroger's and you buy a pound of hamburger, right? Not taxable. Not taxable not under the Constitution, but under the way the sales tax is written in Michigan, right? But you go to McDonald's and you buy a hamburger, there's a sales tax. Right? And again, if you ever pay for your McDonald's, you ever look at your check that you get from McDonald's, it'll include a sales tax. Why? Because that's food prepared for immediate consumption. If you go to a restaurant, let's say you go to Hillsdale Brewing Company and you get their flatbread with pulled pork or something on it, okay? You're going to pay a sales tax on that. But if you went to Kroger's and bought the ingredients for that, you don't pay a sales tax on it. And again, that's an idea of pretty much that from a public choice perspective, why did that get in there, right? Why is that part of the Sales Tax Act? It must be, if we sort of think about it, it's probably part of the Sales Tax Act because the average person may think that this is more equitable to exclude food that is, if you're a rich person, you're out there, buying fancy restaurant meals, and if you are a poor person, you're making all this stuff at home. Yeah.
How does sales tax work for online retail?
That's what we're going to come to next time. Yes, that's a very important question. How does it work if Amazon, if you buy something from Amazon and it gets shipped here, do you pay the sales tax? Who collects it? And there's a series of U.S. Supreme Court cases on that. In fact, I put in the Wolfram 402 in your subfolder under the consumption, I put an article in that says the Supreme Court case that saves states billions. Okay, so there's a recent Supreme Court case that overturned an earlier Supreme Court case about would Amazon have to collect the sales tax if you bought something from Amazon? So that's a very good question. So for Friday, we will probably get through. The consumption tax, and then we'll move on to property tax. Okay, and again, no office hours today. I'll have office hours in the morning tomorrow.